Markets come into Monday with a cautious but constructive tone shaped by a mix of geopolitical risks, central bank anticipation, and inflation sensitive commodity moves. Oil remains a central macro driver as uncertainty around Iran diplomacy and lingering Middle East tensions keep a geopolitical risk premium embedded in crude, reinforcing inflation concerns and feeding into broader cross asset price action. In FX, the dollar is softer overall as markets balance geopolitical risk against a more cautious Fed outlook into this week's FOMC, with the euro supported by relative resilience in eurozone fundamentals, the yen bid on safe haven demand and growing expectations for further Bank of Japan normalization, while commodity currencies are finding support from firmer risk sentiment and relative policy support. Across border markets, the dominant story is positioning ahead of major event risk rather than outright de-risking. U.S. equity futures are mixed, but tech continues to show relative resilience, helping support sentiment even as higher for longer rate risks and elevated energy prices keep pressure on valuations. The macro debate remains centered on whether rising oil acts as an inflationary headwind that complicates the policy outlook, particularly for the Fed. Gold remains underpinned by haven demand, while industrial commodities are watching both geopolitical supply risks and the China growth pulse. On the calendar, focus in Europe will fall on German consumer confidence and broader demand indicators for clues on whether growth stabilization in the Eurozone is gaining traction. In North America, markets are largely looking ahead to the Fed, with incoming activity and inflation signals likely to be filtered through policy expectations. More broadly, this week's twin anchors are the Fed and BoJ, with markets watching whether the Fed leans hawkish against easing expectations and whether the BoJ opens the door for more clearly to further tightening. Into Monday, the backdrop is one of cautious risk taking, softer dollar bias, geopolitically supported commodities and markets, increasingly trading the tension between central bank restraint and a more inflation sensitive macro regime. That's all for now.